Record.
Okay, so I'm calling the meeting to order, and the first item is minutes approval, the minute approval from the May 12th, 2025 meeting. Yeah, you can vote.
Support.
Did you make the motion?
Oh,
Okay.
Just asking.
So I'll take you, you're making the motion to approve the
Okay, so I'm
minutes
making the
by
motion.
Bob.
I'll second.
Okay, seconded by Brooke. Any discussion? All in favor, say aye.
Aye.
All opposed, motion carries. Okay, next up, SEI Investment Status Report. Florence and team.
Thank you. Good afternoon. Nice to see, to be back here, last day. Let's start on slide 10, and joining me is actually Ryan Wall. He was here maybe a year ago around this time. And he's here to help with the strategic asset allocation review conversation that we're gonna have. But I'll start with the market economy and portfolio review. A very, very busy first half of the year with policy activity. Uncertainty remains highly elevated, but markets have strongly rebounded. Equity markets have strongly rebounded from the lows we saw in early April. Now, when it comes to equities, we saw a risk-on rally where high volatility growth and speculative names rallied and outperformed, and we are back to mega cap technology driving and AI driving performance. In fixed income, we saw a steepening of the yield curve, but the US yield curve, but also spreads tightened further. And the one key thing to year to date that's notable is the weakening of the US dollar and the impact to performance. So as we go through this report, key takeaways, it's also your fiscal year end, a very strong net of fee return of 14.3%. Diversification has really continued to benefit total portfolio performance. And I did talk about the weakening US dollar. What you'll see is that your non-US exposures, both in equity and fixed income, have benefited from that and do have strong returns. And of course, your funded status is at 95.5%. So you look at slide 11, really pointing, some of your best performing funds here within equities for the fiscal year, 20.3% from international equity. Global Managed Volatility Fund, that's split between, it's a combination of US equities as well as non-US equities. A strong double-digit return as well of 19.5%. For the year, US equities were actually very strong for you for the fiscal year at 16.2%. And when in a couple of slides, when we look at US equities just year to date, you'll notice a strong rebound and almost matching the performance of the non-US equity market for the same time period. I believe for the second quarter, sorry. So fixed income, I did talk about the emerging markets debt, your non-US exposure within fixed income, a strong double-digit return of 14.2%. High yield has also benefited the asset class, and those are your return enhancing funds with fixed income, of course, characteristics. And then you've got the Dynamic Asset Allocation Fund. It's an overlay on the S&P 500. And when we are modeling it, we look at it as US equity. So also a double-digit return for the fiscal year, 17.3%. So overall, your US equity exposure for the fiscal year was very strong. So you do have also the alternatives in private equity. Those continue to do well, about 48% called in the most recent valuation, March 31st and December 31st, 2024, with a total IRR of 5.3%. So, and that really says broadly across your portfolio, good performance. So broad market performance on slide 13, looking at the calendar it's not the calendar, but the trailing 1 year, which is your fiscal year, you'll notice that everything is to your right, meaning everything is positive. And what you'll notice is just in line with my comments, World ex-US, which is a proxy for the international equity, emerging markets equity, the best performance, the best performance there. US large cap also doing well, and within fixed income, it's emerging market debt and high yield. So pretty much in line with how your portfolio is performing. Then you look at the quarter, the most current quarter, the Q2, that's the brighter blue bars there. Maybe notable is really the performance of the US large cap space. And you look at that compared to the World ex-US and the emerging markets equity, that just shows a very strong rebound of the US equity market in the second quarter, closely aligning in performance at around 10%. And then the only really area that underperformed during the quarter was commodities. The next few slides, I'll hit on key economic data that's in the headlines, and we'll start with slide 14. And that's really the measure of policy uncertainty. As you can see, going back to the 1900s, we are at historical levels, and this measure is just not for trade policy, but also includes monetary and fiscal policy, regulation, and national security. And the next slide looks at, again, the big topic, tariffs. So where we are today compared to history. So when you look at history, the peak there was almost 20% in the 1930s, and today, which is probably a dated number here, but what we are showing, close to 16%. And the next slide is the job market. And you look at, so the yellow line is the median wage growth for job switchers. And the darker line, which is a black line, that's the overall median wage growth. And then the blue line, that's the quits rate. So when you look at where we are today, 25, so the dispersion has narrowed a lot. And what this really means when you're looking at the median wage growth for job switchers today, they're not able to demand the same wage gain that they were in the past. And everything is actually, on a downward trend, showing that there's some cooling there. But overall, we are at an employment rate of about 4.2% today. Then inflation, slide 17, looking at CPI numbers for some of the key developed markets, Japan, UK, US, the Eurozone, Canada. We've come down from the peaks significantly, but still in line with what we've maintained. We expect inflation to remain higher for longer. You look at the US and the UK above that 2% policy rate, Japan and the Eurozone, that green there. And so Japan is one of the outliers there at around 3%, but you can see that Canada has actually hit below 2%, but overall, we expect the US and the UK to struggle getting back to the 2% policy rate. Then what could be emerging as a new theme is the performance of the US dollar. So in this chart on slide 18, we are looking at the relative performance of the US equity market and international equity markets, and then change the US dollar. And what this really shows is that the US equity markets will tend to underperform when the dollar is depreciating. The next slide, just in line with that prior slide, to your right, the US trade weighted exchange rate versus major currencies, and that's for the US dollar. And it looks back at the length of the cycles historically. And what you can see is that this has tended to last between 6 and 11 years. We are already on we can see an emerging trend of that weakness, and we're yet to see how that will play out. But like I mentioned earlier, it's a theme that's already showing in the performance of your non-US equity exposure, your non-US equity and fixed income exposures. So I won't really speak to slide 20. It's a summary of what I've shared in the last couple of slides, but there's additional commentary there that you can review at your leisure. Slide 21 is our standard summary views regarding the strategy more broadly, the investment strategy more broadly. From a cross-asset perspective, I talked about the weakness of the US dollar, but what's notable, I believe maybe this quarter is the our view on gold. It's attractive it's attractive in a weakening US dollar regime, but also importantly, we've added it as a hedge in your US dynamic asset allocation fund recently. Within equities, that hasn't changed much from what we've shared in past quarters. Diversification remains very key, and we have an emphasis on diversification across geographies and market capitalizations, and maintain strategic exposures in our alpha sources, value, quality, and momentum, with an emphasis on value. And active management looks attractive in this current market environment. Fixed income, we are defensively positioned, favoring securities over credit, and that has really, helped performance of your core fixed income and limited duration. But also, we are positioned for a continued steepening of the U.S. and European yield curves, and we've seen positive results where we have that exposure, like in the dynamic. Your fixed income funds, as well as the dynamic asset allocation fund. The funded status, slide 23, strong at 95.5%. So I'll pause and see if there are any questions before we get into the details. The portfolio.
Okay.
No questions? Okay,
Nope.
good. So starting with slide 25, and that's the net change in market value that over there. The 1 year, that's your fiscal year. Very strong net change. So there was about 3.4 million that left the portfolio, benefit payments as well as management fees, but very strong investment gains of 10.8 million, significantly offsetting what left the portfolio. Year to date, a similar trend, 1.8 million has gone out of the portfolio, but strong investment gains. And this is calendar year to date of 6.5 million. And in terms of where you stand actually, where the portfolio sits actually from an asset class perspective, you are in line with the, you are within the investment policy ranges. So slide 26, first row, that's your gross of fee return. Second row, your net of fee, and then you have two benchmarks here: the portfolio index as well as the 60% MSCI ACWI, which is the broader equity universe, and the 40% global ag. So looking at my comments are going to be on the fiscal year as well as the most recent quarter. Looking at your fiscal year, very strong return, like I mentioned, net of fee of 14.3%, outperforming the both benchmarks that you have there. And when you look down the column, including the next slide, you'll see very strong performance both on an absolute and relative basis across most of your funds. Then you look at the quarter, and so for the most recent quarter, like I mentioned earlier, it was really driven by growth, speculative names, and that really didn't quite favor our style. We tend to, our investment is based on these long-term proven drivers of performance, quality, momentum, and value primarily, but low volatility as well. So the only thing that really did well there was momentum factor. So you still have strong absolute performance, but when you look at relative performance, not as strong across many of the funds. So we'll start with your US equity exposures. You do have passive and semi-active, and we did your semi-active is 3 years now. When I look at at history there. But one of the things that we've been doing really is to diversify the concentration within the S&P 500 with that US equity factor allocation fund. You've had it for some time. For your small cap exposure, you do have extended market index. It does have some large cap and some mid cap, but also what we will be doing today, and Ryan will get more details about that, is introducing active management within the small cap space. So we'll introduce an actively managed SMID fund. So your US equity factor allocation fund, so it has all of those exposed to all of those 4 factors that I talked about. And like I mentioned, they all struggled except for momentum. World ex-US international equity, very strong performance for the trailing 1 year, but for the quarter, strong absolute return as well, lagging the benchmark. Because of that, again, the style, the value exposure, but also the fact that we were underweight some of the best performing sectors like banks and REITs. Then you've got your global managed volatility fund, which tends to do very well in down markets, and has held up very strongly on at least for 1 year basis, but still a solid positive return for the quarter. Fixed income, total fixed income, very strong return of 7.9%. Then, as you can see, you have exposures across intermediate part of the curve, but also towards the shorter end of the curve with your limited duration fund, but also these return enhancing exposures in emerging markets debt and high yield bond fund. Strong performance across all 4 for the fiscal year, or as well as the 3-month. Driving performance in your core fixed income for the quarter was our positioning, our yield curve positioning, but also the securitized assets that I talked about, and also helping performance within limited duration was this securitized exposure there, asset-backed securities, CMBS, as well as mortgage-backed securities. High yield bond fund, strong absolute returns for the fiscal year, for the quarter as well, but lagging the benchmark for the quarter because of really security selection, but the underperformance of our loan exposure. Within alternatives, your private equities funds on a time-weighted return, and we'll see the other, the IRRs, but there were time-weighted returns very strong for the fiscal year. And we did actually get a capital call for your most recent commitment, which is the G7. That's the one with that small market value there, 92,300. The dynamic asset allocation fund, I did talk about that, doing very well for the fiscal year, as well as the 3-month. What has driven performance there is our yield curve steepeners, but we overlay the S&P 500. The key themes there are stickier inflation, US debt dynamics, as well as the divergence of monetary policies.
Lawrence, can I ask one question? I'm sorry. You said that there was an underperformance of a loan fund. Did I hear you correctly?
No, so loans exposure. So we do, within the high yield bond fund, we do have a CLO, collateralized loan exposure to that, and that didn't do very well during the quarter, and it was a detractor. But of course, you do have other securities within that fund.
Okay.
So nothing just pinpointing something that detracted from the relative performance. And when I talk about that is, so you still have a strong absolute return of 3.3.
Yeah.
You can see slightly lagging the benchmark. And what contributed to that was some security selection in other areas, but also that particular exposure.
When you say that it is lagging the benchmark, which number are you referring to?
So for the high yield bond fund, so the benchmark is the very light gray, the high yield.
That is the benchmark.
Fund. Yeah. So each fund will have a benchmark.
Thank
except
you.
for the global managed volatility fund, where we really don't show up.
Understood.
Yeah, and the,
Well, that's super helpful.
okay.
Thank
I
you.
appreciate that. I appreciate the questions. And I want to make sure we are all on the same page.
Yeah, thank you.
You're
That's
welcome.
great.
Then slide 28, that's the better way to look at the performance of your private equity funds. We are not showing the GPA 7 here because it's your most recent commitment. There's usually a lag in performance reporting, but also to the reporting itself. So hopefully maybe in the next quarter, we'll be able to show that. But when you look at your total internal rate of return, for the two funds, it's at 5.3%. You look at also the vintage years, 2022 and 2023, very early in the investment cycle. If you recall that J curve, you still have 5 years of that muted or negative expected return during that period. And then after 5 years, that's when you start seeing distributions. And in this market environment, we have seen slow distributions, and managers are more focused on investment, on capital investments. All right, if there are no questions, we'll transition to Ryan.
All right, thank you. I'm going to turn to page 31. Handout. So I'll walk through, and we have Ryan Wall on the SEI, on the advice team. So today, for walk you through a couple of different slides, we prepared a asset allocation recommendation. We also want to show you as a third fiduciary SEI, two other portfolios, and more conservative, more aggressive, just so you can compare and contrast results and the trade-offs between higher returns and how the risk profile of those portfolios would change. So we performed a stochastic analysis to show you projections over a 10-year time period, to show you a range of outcomes and possibilities with those portfolios. That way you can help evaluate those trade-offs and why we think there's a benefit with the recommendation today. So on 31 is just to kind of start off with the key characteristics of your plan. We show you those, break them down. Some plan demographics on the far left-hand side. Plan overview is an ongoing plan. We provide a liability overview, and that just calculates how your liabilities grow by interest costs, and then we account for any benefit payment depletion. So then the bottom metrics where it says hurdle rate, you subtract or deduct a contribution, then you get to a net hurdle rate number. This is a metric we look at internally to evaluate whether, kind of as a starting point when you construct portfolios, to make sure that your allocation today is sufficient to meet its required rate of return, and your plan's funded status, we project it to continue to improve and grow. So the hurdle rate shows at 8.9%. So when we define hurdle rate, what that means is, what must your plan earn to maintain the same funded status 1 year from today? So 1 year in the future, your plan would require 8.9% return just to maintain your current funded status, which we estimate to be around 95%. Then we factor in your contributions to the plan, it drops it to the net hurdle rate number. So if you back out your contributions, the net hurdle rate we calculate at 6%. So that's what your portfolio must earn to improve funded status after you account for plan contributions. The plan metrics, the two columns to the right, just show you the kind of the starting point for the stochastic analysis. Now, these numbers are as of your last accounting and funding valuation reports. They're a little dated, but once those new reports should release very shortly, we'll update our numbers as well. Because if you look down below on the first column, the bright blue, it shows you your funded status as of June 30th, 2024. At the time of your last report, it was just shy of 90%. But as you heard Florence report earlier, that we estimate your plan's funded status now through June 30th of 2025 is actually in excess of 95% funded status. So you improved by 6% estimated funded status over the last year, which is a great result. And then we show you your funding standard account on the far right-hand side. It just shows you get an idea of the total employer contribution that's going in every year to that hurdle rate calculation. So that's the starting point for today's discussion and how we look at what's a sufficient return to not only maintain, but also hopefully improve your funded status in the coming years. If you were to jump to page 33, on page 33, we give you a detailed breakout of 4 different portfolios. If you look on the far left-hand side, that's your current allocation, how you're currently invested today. We show you 3 other portfolios, A, B, and C. Our recommendation today, our best thinking based off of your plan demographics and what we've seen and experienced over the last 12 months, we think our recommendation, our best thinking is going to be portfolio A. Portfolio B and C. B is a more conservative allocation and C is a slightly more aggressive. Again, as a co-fiduciary, this is something we always continue to monitor at least once a year, that we do projections and make sure that you're properly allocated. But I'll focus on what we're recommending on portfolio. If you have any questions, please let me know. So you can see, if you look at your current allocation, again, on the far left-hand side, you have 68% of your assets in return-seeking assets. Not just equity, but we call it return-seeking, because we also include high-yield emerging market debt. Even though they are fixed income, they really behave like equities, and we include them in the return-seeking assets because they're not used to hedge any risk within the portfolio. It just really is a point of diversification and return. So you're currently situated with 68% in return-seeking assets. You have 27% in risk management. We can kind of traditionally think of it as your fixed income, your limited duration or fixed income. But then you also have a 5% exposure to alternatives as a point of diversification and for returning. Florence just went through some of the historical performance with those vintages at a 5% weight. Portfolio A, for our best thinking on our recommendation today, we're not recommending any overall changes within the weighting between return-seeking assets and fixed income. They remain at 68% return-seeking assets. If you look down the subtotals, you can see total return-seeking enhancement, still the exposure is still 68%. The risk management remained at 27%, and the alternatives is unchanged at 5%. Where we're making the two changes within portfolio, our recommendation is first, with your, if you go to the second and third row, you can see that U.S. small mid-cap equity strategies listed also with your U.S. small mid-cap equity index. You currently have a 4% exposure to this small mid-cap passively managed strategy. We're recommending today that you split that 2 and 2, kind of that 50-50 or barbell approach. And we think there is benefits to having a very small weighting to active management within U.S. small cap and small mid-cap. And what we've seen over the last 20 years, we've seen a kind of a growing share of that benchmark, that passively managed strategy, being allocated to what we call non-earners or unprofitable companies within that small mid-cap exposure, where those companies aren't profitable. 20 years ago, 25 years ago, it was in the mid-teens. So that benchmark, 15% of the companies were not profitable, but they were included with the benchmark. Now, with the small mid-cap extended market index, we've seen that in the benchmark rise to 37% of the benchmark. They're unprofitable companies. So we think there's benefit is being more active and providing additional degree of selection and picking high quality, profitable small mid-cap companies. That's why we think it's appropriate to split that allocation 2 and 2 and give those managers discretion to be more selective in picking high quality, profitable small mid-cap companies. So a small change there. We're splitting that allocation from 4 to 2 and 2, active passive mix. The second change within the recommendation with portfolio, if you go to your risk management bucket, you can see currently you have 14% in your limited duration fixed income fund and 13% core fixed income. Core fixed income is your Barclays and your high quality U.S. investment grade fixed income. Or limited duration is a shorter duration profile. So it provides some benefits in a rising rate environment, but really now that rates have risen since the end of 2022, we've seen a historic 500 basis point rate rise from the Fed at the end of 2022. Rates have kind of remained range bound since that time period. SEI's view is that rates are going to remain higher for longer and kind of in between that 4.25 to 4.75 range. So we think you would benefit from slowly lengthening your duration profile of your plan. Also, you'd also benefit if rates were to drop, you benefit from having a longer duration position within fixed income. So what we're recommending is you take 5% weight from limited duration. It's currently 14. We'd recommend dropping that to 9% and increasing your core fixed from 13 up to 18. So really go to a kind of a one-third, two-third split. Right now, you're close to a 50-50 split within your fixed income, kind of shorter to mid strategy and then mid with core fixed income. And we recommend going to 1/3, 2/3 blend. We think you'll benefit from clipping that higher coupon with core fixed income as rates in our view remain range bound. So those are the two
Core
changes.
fixed income is longer duration. Is that what I heard?
Correct. Yeah, core fixed has a duration profile between 6 and 7.5 years.
Okay.
It will vary. The limited duration is shorter. You can think of that as kind of 3 to 4 duration profile, really anywhere 2 to 4, I should say, years of duration profile. You think of long duration, you don't currently hold any long duration, a lot of pension, like corporate plans would use long duration fixed income. That has a duration profile of over 14 years. So depending on the client, the interest rate environment, we typically will make some adjustments based off the shape of the yield curve and the environment within the credit markets. Right now, we think the way it's positioned and our outlook for rates, we think you're better off with a 2/3, 1/3 split between your fixed income. So those are the two changes today. With that, if you look down at the portfolio metrics at the bottom, there's no fee impact with portfolio A. So it's fee neutral. The other thing I want to point out too is if you go up a couple rows, start off with portfolio metrics, the expected return, we think it actually has this over a 10-year time period, we kind of define as the short term. We think it probably roughly about 10 basis point higher expected return in median scenarios over a 10-year time period or short term time horizon. And similar increase in expected return with your equilibrium assumption or long-term rates. Not much of a change within your risk profile, maybe a hair higher degree of risk, standard deviation goes from 13.5 up to 13.6. We don't think it's a meaningful increase. And then portfolios B and C, again, as comparison, portfolio B, we de-risk the plan. You reduce your equity or return enhancement exposure by 10% down to 58% from 68%. And we would increase your fixed income equal measure from 27 to 37%. And what you'll notice that with that more conservative allocation, your expected return, to go down the portfolio metrics, you see it would drop roughly 30 to 40 basis points down to 7.1. And then portfolio C, similar directional move. This one is more aggressive, increasing the return enhancement actually from your current position from 5% higher allocation to return enhancement. And your expected return would tick up to about 7.6%. So slightly more aggressive. Our conclusion is right now you're properly allocated. Your risk profile is appropriate. We don't think that you need to take any risk off the table as far as more conservative allocation would be or a more aggressive allocation would say it's really unnecessary. So what you'll see in the coming pages is the projections, how the funded status and your market value play out over a 10-year time period. Are there any questions with the allocations? Before I get into the projections.
So you're going to an active small cap, right? Is that what you said? 2% active and 2% index? Is that?
Yeah, currently just adding 2% and then reducing your passive by 2%. So splitting your passively managed small mid cap strategy.
Okay.
2 and 2.
My question is, it's fee neutral. So how are we making up the fee that we're not? Because we're active, you typically pay a higher fee, right?
Yeah, we usually run the numbers, and if it's kind of on the edge, obviously we're not going to come out and try to do a fee increase, 1 basis point. It's a fee neutral move.
Okay.
So it is a slightly higher cost, but sometimes based on the plan size and the dollar amount being allocated, this is just a small weighting. It didn't move it enough to warrant a fee increase. It's only a
Okay.
2% move.
Okay.
If we're shifting 5% in, you may have a basis point or 2 increase, but since it's such a small allocation, it didn't change the fee calculation.
Okay. All right.
You said that C was the most aggressive one?
Correct, listed, yes. So your total return enhancement exposure would go up to 73%.
When would you recommend something like that? Is it someone who's maybe underfunded? Like,
Yeah, so your plan right now is in very good shape.
Mhm.
I just mentioned earlier that you started the year off with your last fiscal year, 6/30/2024 at 89%. You've had a great return this past year. You talk about the expected returns. You had these portfolios are really designed to kind of generate returns at 6 to 7% median scenarios. Your net of fee 12-month return was in excess of 14%. So well above median expectations. It was a phenomenal year, and your funded status improved 6%. Where we would probably recommend portfolio C is if your funded status was lower, your time horizon was longer, and you could afford to take your risk tolerance. You could increase your risk tolerance if you could withstand that volatility from an employer contribution standpoint. Since you've picked up 6% over the last year, you're closing in on a fully funded plan. Obviously, we'll still maintain that 6% hurdle rate. But right now, we don't think that you need to go to portfolio C. It's only a slightly higher degree, but why take the risk? We still project an increase in funded status with your current portfolio A.
right. Yep, thank you.
So on page 34, this just shows you a distribution. I referenced the median returns for portfolios in that 7% range, but this shows you a range of outcomes from the 95th percentile outcome, very good scenario, down to a 4th scenario or 5th percentile. We do it for each portfolio. You can see that I mentioned your return net of fees over the last year was over 14%. So on a probability distribution, that's what I experienced really. It was close to that 75th percentile. So if you look at that first column, 25th percent or 75th percentile return for your current portfolio, we estimate about 16.8. So well above, last year was well above the median. But what you'll notice directionally though is portfolio A, slightly higher median expected return, similar downside risk, about 12.5%, the drop 12.5% in poor scenarios. But with portfolio B, since it's a more conservative allocation, you can see that band slightly tighten because you're not going to experience all of the upside. So the most favorable scenarios are a little lower. And your more conservative, the poor scenarios are a little higher because you're moving more into fixed income and risk management. So it only would drop about 10.8%, but you're giving up a small degree of expected return on an annual basis. Portfolio C, again, more aggressive. The range of distributions is a little wider, not by much, but a little bit. But as it compounds over 10 years, you'll see those results play out on a dollar basis on a second. Slide 35. It's a similar table, but just showed you the equilibrium returns as returns projection greater than 10 years. Directionally the same though, similar band for portfolio A, portfolio B, a little tighter, more conservative allocation, portfolio C, wider, more volatility because it's relying more on return-seeking assets. So if you go to your market value on a dollar basis, we do this projection. This is at 10 years from now, what a dollar value of money is. Right now, you're right around $85 million. You can see that your assets, even accounting for benefit payment depletion as you pay those plan participants, we still think your overall asset value will continue to grow over the next 10 years, which is great news. And again, if you look at portfolio A, this is where you can see the benefits of moving kind of to that higher quality fixed income or fixed. If you look at portfolio A in the poor scenario, 5th percentile return over a 10-year time period, in a 5th percentile outcome, you actually have some more downside protection with portfolio A. Not by much, but a little bit. Your market value would be 70.6 million versus 70 million for your current. So it's better, higher market value in your poor scenarios, your 25th, your median, your 75th, and your good scenarios. So really in 95% of the scenarios, you're going to have a more favorable outcome with portfolio A. Portfolio B, you can't say the same. You do give up some meaningful improvement in market value for portfolio B in median scenarios. You can see that versus your current of 125 million, your portfolio B in median scenarios would drop to 121.5. You have a little more downside protection, but you give up in all the other scenarios. And then portfolio C, more favorable median scenario, but in poor scenarios, you could have an outcome less favorable than your current implementation. So this is the most important slide is your funded status, funded ratio perspective. Skipped actually, that was actually page before on page 36.
I had a question on page 30. Oh, sorry, you want to go 36?
Yeah, sure. 36, you can see regardless of the portfolio pick, the median scenarios, whether it's the current A, B, or C, the median scenarios, a reallocation would have a funded status of 100% or greater, so a fully funded plan on an accounting basis. But again, portfolio A versus the current, more favorable outcome in 95% of the scenarios. Whether it's the full return, the 25th, the median, 75th, or 95th percentile, more favorable outcome in all those scenarios with your portfolio A. Portfolio B, more conservative, you're gonna give up a median and more favorable scenarios, slightly more better downside protection, and then portfolio C, the opposite. It has a lower outcome in the 5th percentile. I'm sorry, there's a question?
Yeah, it was on 38.
Sure.
So this is cumulative employer contributions. And the number is higher for the good scenario.
Yeah,
And-
there's an issue with that legend on that key on the side should be flipped.
Okay,
So that would be really four, because the higher the contribution is really a poor scenario.
right, exactly.
So yeah, it's a good catch. The 95th, and this should be listed as the poor.
Okay,
So the more favorable outcome obviously would be putting less money into the plan.
exactly.
So you can see though, moving to that allocation we recommend in portfolio A, better experience, lower contributions in 95% of the scenarios, whether it's the 95th, that light gray bar, slightly lower than your current, and then lower contributions or the equal to the current limitation and all the other scenarios,
Okay,
which is obviously a better outcome for the city.
right.
Can you help me understand on slides 36 and 37? It looks to me like portfolio C looks really nice, but I feel like I must be missing something.
It does, but if you were to go to the poor scenario, the 5th percentile,
Mm-hmm.
it's 63% funded ratio, and in the poor scenario, it is below. the current
I
at
see.
64.7.
I
So
see.
better
And
out-
it's the 68.5 on slide 37 is
correct.
lower than the
As well, yeah.
70.6. Okay,
But
thank you.
portfolio A is higher in 95% of the scenarios, where portfolio C is only more favorable outcome in 75% of the scenarios. So
Got it.
you're still probably more likely, based on probability, to portfolio C over time, but it's not necessary. Portfolio A is still gonna get you to a better experience. There's no fee impact, or what, you don't need to take the excessive risk. The risk profile would increase slightly with portfolio C. We think we can make minor modifications to portfolio A and improve 95% of the outcomes versus just 75.
With greater confidence.
Correct.
Thank you. Of
Obviously, we can't
course.
project those tail events of the black swan outside of the 90% or 95% of those scenarios, really kind of any greater than 2 standard deviations on each side. That's really the unknown that we really can't model. But in the vast majority of scenarios, we think that portfolio A is the prudent move.
Got it, makes sense.
Thank you.
So that concludes projections, but we do try to run this analysis at least once a year, like back last year. So we think there are 2 small changes, repositioning, no change, really, no significant change between the mix between return enhancement, risk management, and alternatives, just minor modifications within those subcategories.
Okay,
So we need a motion to.
yeah, we do. So SEI is recommending portfolio A,
That's correct.
so I
I'd
will,
like to make a motion to move forward with SCI's recommendation that we adopt portfolio A.
Smart. Any further discussion?
Mhm.
Okay, all in favor, say aye.
Aye.
Aye. All opposed, motion carries. Great, thank you.
Thank you.
I think as always, you've completed your report, right?
Yeah, we've
So-
completed our part, and I have another meeting, so I'll leave early, then
Okay.
enjoy the rest of the summer.
Thank
Yes.
you.
Yep, you too.
Good to
Thank
see
you, Florence.
All right, let me get back to the agenda here then. So Fund 731 financial reports.
Which page?
I'm looking for it. I should be able to find it. This doesn't,
Thank you.
is it not navigating there?
87.
I'll just scroll there.
Bye, thank you.
Thank you. All right, Ben? You covering this?
Okay, so these are preliminary year-end numbers, having closed the year all the way. Total assets at June 2024 were $77.7-ish million. Total assets at the end of this year were 85 million, which is a gain of 7.3, just like we were talking about during the presentation. The net of revenues and expenditures, which is the increase of fund balance, last year was 5.2, this year is 7.3. And then the balance sheet and the revenue expense reports are attached.
There an action required here?
See one, just a report.
It's just a report. Are there any questions for Ben? I just let people take a look at it before we move on to the next item.
Mm.
Okay, so no questions for Ben. We'll go on to old business. And first item there is the actuarial audit update.
Yep, so the pension side is done. On Friday, we received a draft of the OPEB. It's early to say, but it's also good news, like we saw on the pension side. The next meeting, Foster will be here at 12.
Okay. All right. No questions?
No.
We will move on to birth certificate update.
Right, I really don't have an update for you on that. Our subcommittee has not met since our last meeting. We haven't had any other issues that have arisen. So, I will schedule a meeting after this so we get the subcommittee back on track.
Who was on the subcommittee?
Adam, Bob, and Sam, I believe.
Okay, and you as well? You're
Yes.
part- you're-
Yeah.
Okay.
As I recall, I think one of our biggest hangups was spouse verification of the spouse date of birth.
Well, we
Because
had two issues. One was employees. They typically will get verification when they begin employment here, but we don't retain copies of that in the personnel file. So what we had talked about was getting a checklist to make sure it was verified at the time of employment. We had an issue with an employee who didn't want to provide it because they said they already provided it, and there was a little bit of a disagreement about that. We weren't concerned about fraud. It was just trying to make sure we have a uniform process and we do our due diligence and making sure we have accurate birth dates, names in that. The spouses, we don't get when somebody is employed. Spouses can change. People may not be here to vest. I mean, there are a lot of reasons not to get it at the time they begin employment, but we do ask for that at the time they make their elections. And I don't believe there have been issues with getting birth certificates. Part of what we had talked about is sometimes there really could be legitimate difficulties in getting a birth certificate. People aren't all born in the US, and then sometimes it's just difficult to get a good copy of a birth certificate. So that was another reason to look at alternative ways of trying to verify birth dates.
So you're gonna look at that with the subcommittee.
Right.
Okay. Any additional questions for Lori on that?
No.
Do we take public comment now or on the items? I guess I haven't run meetings like this.
I mean, there's a spot at the end of the meeting. We haven't typically taken it, but that's up to you as a chair.
If we follow suit with the commission meeting, we take comments as we're
As on each item.
on each
The-
item. So
Well, the
let's just
commission
follow.
meetings, I have no objection to hearing comment, but the commission meetings usually have public comment when there's an action.
Mhm.
Okay,
Before a vote.
Yeah.
Something.
okay,
But that said, I think we could take public
okay.
comment.
Well, we'll
Just-
take public comment. Yes.
All right, and I don't mind writing it in.
What is your name?
Debbie Johnson, 1919 Forest. And probably wondering why is this crazy lady here at the pension meeting?
We're thrilled to have you.
I worked at Whirlpool for many, many years, and that was my job. One of my jobs was calculating and auditing all of the pension payments from North America.
Oh, wow.
And part of that was you had to provide your birth certificate, an original certified copy. And there was a list of alternate documents you could provide. And all of the hundreds of pension payments that I audited and processed, there were rarely any issues with people getting a original or certified birth certificate. And what else did I want to say? If you apply for your social security, you need to provide your birth certificate. So, and I think, yeah, and if you look on the social security website, there's an alternative for different IDs you can provide if you really
Mhm.
honestly can't get your birth certificate. And it doesn't matter if you provided it when you were hired, you still need to provide it when you retire, because you're getting an excellent, excellent benefit. And I looked at this plan and it's like excellent retirement.
Mhm.
Thank you.
Thank you.
Okay, thank you.
I'd love to go on record again. I know I said this last time. I feel like it should not be a problem for someone to give us their birth certificate when requested. So I just want to put that out there for the subgroup when they meet. I think that if that is what we think is needed to see it again, I just think that should be easy to do. And building off of what Debbie said, if there are plans out there that we can borrow from to get that, list of alternative documentation, we should do that.
Right. I think between a birth certificate or the alternate form, this should not be something that's that hard to do.
Agreed.
Um,
You don't have to provide it if you don't want the benefit.
right,
Yeah.
so.
Yep.
Okay. All right, so with that, we will move on to new business and the Fund 731 invoices paid, Ben.
Okay, total invoices, approved for $796.71. They're all from the basic department system. Attached is the list of invoices for review.
I think the one thing when I look through this, a lot of the invoices have to do with the trainings. And over again, they tell us at the MAPERS conferences that they hold the whole certificate of completion, and you need to attend at least 6 sessions in order to get the certificate of completion. And I think that that's something, I don't know that we verify that the people that have attended have provided their certificate of completion. I think that's something important to do. I don't think we have a problem with it now, but again, at the conferences, they say you don't wait till you have a problem to address it. If you think it's good policy, then you do it in advance, so people don't say they're picking on me, that kind of thing, that you're making an exception. So I would kind of like to see that happen, or some kind of policy procedure happen, so that if you go, you're expected to turn it in. I also understand there's extenuating circumstances where sometimes you have to come back early. Things are blowing up back at the city and you have to leave early, recently. So, and that's completely understandable. So I think it just should be documented. So we're being good stewards of the pension funds dollars is what it boils down to. So
I agree. Do we get those individually? Can someone pull those from MAPERS after the conference? How does
They-
that work?
they come individually, and I always give mine to Sam. I mean, I want to don't have a problem, want to have a problem with public scrutiny, so I always want it in
Mhm.
my file. But I don't know that everybody does that.
I don't know if I've ever even seen one.
Yeah, they come back.
You
They
email them
they
to
sent,
us?
Michelle
They
Moran,
do?
Duran
how
will
about
send it to you.
Great.
gotta complete though.
You do.
I go to all the sessions.
Do you do the check-ins?
Yeah,
Yeah, you've
I
got,
do.
you've got
I
them. You just
probably
haven't,
have.
you just haven't seen it.
okay.
So that's the only thing that I'd ask.
Not
is
just
that-
there to hang out, I promise.
That we document, or, you kind of look at, if you only went one day, well, your expenses for your hotel and stuff are less, that kind of,
Right.
whatever,
Right,
just to make sure we're being good stewards.
I think that
That's
makes
all.
sense.
So with that said, we do approve the invoices paid.
Okay, I move to approve, and read this payment of invoices paid from the retirement system fund in the amount of $19,796.71.
Support.
Supported by Adam. Any further comment? All in favor, say aye. Aye. All opposed, motion carries. Next item is a resolution for the final service retirement for Joan Ross.
The date of birth is that redacted for
Date of birth
privacy?
is redacted.
And so is there like a copy that has the actual date of birth, or is this the official one with the X's in it?
That is verified as part of the application process, that same as a checklist that she'll go through, but we can't provide that birth date publicly, and all of the minutes and documents with this meeting are public, so that's why it looks like it does.
This is just like a copy with it redacted. There's a good one with the real date of birth in it.
Yes.
Okay, thank you.
Now you calculate that in-house, right? This isn't calculated by Gabriel Roller Smith?
No, it's still calculated by, GRS. I do the estimate in-house and then I send it to them for the final calculation.
Okay, and then they have to go in and look at the mortality tables and whatever's in order to, if it's 100% survivor benefit, then they're gonna reduce the benefit amount and such, so.
Do you need a motion on this one?
Yes, we do.
To just accept it?
It's, I don't know if it's to approve the resolution or to, what, Ben, how do you want that?
Yeah, I put that on here. I guess, Lori, we should have the motion say to approve the resolution.
Yes, yes.
Okay. I move to approve the resolution for Joan Ross.
Support.
Moved by Brooke, supported by Bob.
Yes.
Any other discussion? All in favor, say aye.
Aye.
Aye. All opposed, motion carries. Refund accumulated contribution, there's like 6 or 7 people here. I can't help, but I have to say this, is there anything that we can do to try to educate people about the time value of money and what they're doing by cashing this in and taking that penalty? This is probably the worst one I've seen. It seems like we've had a split between some people taking it and some people rolling it over. But it's really pretty easy to roll it over, and why deal with the headache with tax time, plus you're losing that money and all that accumulation that occurs over your lifetime. So I don't know, do we have, I don't think we have an obligation to do it. It just fingernails on a chalkboard to me that we're seeing this right here today. so.
Particularly you get the 4 figures. I can see for a couple $100.
Right,
Doesn't make any
right.
difference, but those two that are what, $4,000 and $5,000 are,
Yep.
Yeah.
holy smokes.
I
Yeah,
do try
and-
to make them aware at the time I go over the calculation with them that they will be responsible for the 20% withholding, but,
Well, as I call, one of the members resigned because they had so many other jobs that we were afraid we weren't getting, the time from them. And so I wouldn't think that money would be an issue if you've got all that work out there. So why not just roll it over?
Mhm.
So, but I don't know if there's something we can do
I
to
do think
better
a few of
educate.
these also defaulted as well. If I don't, it says on my letter, if I don't receive a response within 30 days, that we'll go ahead and cut them a check. So 2 of them, I did not receive a response at all, so they defaulted to receiving the payout.
Okay.
So that might be part of it.
And you communicate to them through what avenue?
In
Email?
person.
In person?
To start the process, and then, I send them a letter in the mail to, send them the final calculation and, let them know they can.
So they had 2
I don't know
opportunities to
what-
get the information and no response. Yeah.
I guess
And
the
if
only
they-
thing that I would suggest is when you're sitting there face to face with them, you might want to go ahead and just tell me right now that's what you want to do because it'll default and this has happened and I know that there's some. people that they
That
wanna
maybe
have
don't
that
want
happen.
to do
But
that.
it's completely up to you. I understand it's completely up to them, but
Maybe we could make a 1-pager or something that we could also hand to them when they come in to meet with you, so they can just read about their options.
Yeah, we have a retirement policy. I think I normally give them, there's a sales tax form that they get with the letter
Mhm.
that kind of goes over that as well. Should be a copy of one in here. The special tax notice regarding claim payments. So yes, they do get a copy of this, letting them know if they cash it out, the repercussions of doing so.
What page is that? Sam?
That is 109. Starts on 109. But yes, I will make sure in the one-on-one conversations that I go over it with them as well.
Yeah, I'm thinking of something. Maybe a little more user-friendly.
Okay.
And a little less small print.
Yeah.
Of just like high-level education on the value of rolling over versus cashing out. And
I mean, if they have questions, bounce them over to me, as the general employee rep. if it's a general employee or for union employee, whatever have you. I'll just try to talk to them about it a little bit. And again, I understand it's their decision. It's just, people are making bad ones in my view, so.
I think like everyone's situation is different. Just looking at these, but.
Yep. Yeah, I understand that too. Yes.
All right.
So we need a motion to refund the accumulated contributions for all of the members that are included under this. I don't know if we need to read them, but
I am happy to make that motion as listed in the packet.
Support.
moved by Emily, supported by Brooke. Any further conversation? All in favor, say aye.
Aye.
All opposed, motion carries. Update or change in beneficiaries. Is this you, Ben, or Barney?
I'll defer to Sam on some of this. 168.
Okay, Patricia Dimmitt, did not have any beneficiaries. She had been paid out her full contributions by the time that she passed away. So there was no beneficiary action needed.
Okay.
Okay.
So there's no action needed on this, that's just a report, right? Okay. Next item is 945 penalty.
Yep, so pension is the payroll, and just like regular payroll, you have to do the full flat payment pay it to the Fed. And the problem we're running into is when we're pulling those payments and make those payments, the IRS thinks we're paying untimely. They think we should be bi-weekly instead of monthly. And what's happening is we are getting a penalty and interest applied from January to little bitty pension once a month. In January, February, March, all through the year, that's being added together. And then they're giving us notice that they're applying a penalty and interest. Because we only pay pension once a month, we could pay multiple payments, but then we're making a guess about how much we're really gonna pay for the month. So we don't wanna do that. We've asked for help from Representative Bill Mazinga of his office. And they have contacted the IRS and asked for a tax advocate for us. And we're in the process of getting a tax advocate so that we can get help from the IRS to figure out what's going on. So that's
That's a
basically
report.
what's happening now.
Do we have any
Right.
idea how long it'll take to resolve? Probably not, huh?
Did I read somewhere that there's a pause on them, more penalties accumulating?
So right now, the current tax year 24, that value, there is a pause, not on the interest being accrued, but a pause on that value going to collections. So it's giving us time before they really start coming out for us. And the idea is the tax advocate will then help us figure out what's going on and try and solve these situations.
And you said we can, best case scenario, we would recover our payment, but we wouldn't get any kind of interest on that. Is that true?
No, so, what's happened is, we have not paid 24. Earlier in this fiscal year, last year at this time, we paid 22 and 23. What'll happen, the hope is with the tax advocate, we'll get that money back and not have to pay 24, and then going forward, not have this issue.
But we wouldn't get any kind of interest on the payments that we made back in 22 and 23,
Yeah, I
was
think
it?
the interest is more difficult to recover. It's a different standard they look at and it's very limited. But the interest is also very small compared
Right,
to
it's
the
not
rest
gonna
of
be
it.
huge,
Yeah.
so. Okay,
So
but by not
that-
paying it, if they come back and say we have to pay it, then we'd have to pay interest, but we're saving not, whatever, we're not gonna get that interest back from them by not paying it, is what it boils down to.
That I don't know. We'll know more when we actually talk to the tax advocate.
Okay.
I just want to applaud Ben and Lori for their work on this. My understanding is this goes back a handful of years and multiple finance directors who weren't able to solve it. And Ben and Lori are focused on getting it solved, which is overdue and necessary. So thanks for your work on it.
Thank you.
And I have to say, I think they thought it was solved and it hasn't been.
Mm,
So,
mhm.
so hopefully we can get it resolved once and for all.
I'm just curious, it seems like a very curious problem to have. Are there other municipalities who have come across something like this?
So part of the reason why it's happening to us, I know from experience at the county, which also has a pension, once a month, same situation we have, but they use one tax ID. Here, we have a separate tax ID just for the pension. And I don't know if on the IRS's side, when they have our account set up, if there's some flag set that we're, because when you apply for tax ID, you have to declare how often you're gonna pay.
Mhm.
I don't know when we did that tax ID, we declared we're gonna be semi-weekly, like a normal payroll.
Mhm.
And it's been forever set on the IRS side, and their program looks at that flag and says, well, they're not paying often enough. I don't know.
Right.
That's my assumption, but I know from experience, we didn't have this problem with the county, because you wouldn't have this problem because it was one tax ID.
Right, right. Okay, and this advocate's gonna help kind of dig through that and figure, okay,
I hope so.
yeah, that's the idea. Thank you.
Okay, anything more on that?
Mm-mm.
All right, moving on to next meeting reminder.
Yeah,
November
next
9th.
meeting is, November 9th, 1:30.
10th.
Oh, is it the 10th?
My calendar says Monday's the 10th.
Pension board. Yep. Good catch.
I went to put it in. I said, whoops.
Yep.
I'm not coming on Sunday.
No.
Okay, the public comment or one public member left? Any trustee comment? I'll do my normal, just encourage everyone to go to the MAPERS conference. I think we have a handful of people that are going. And they changed things up on us on Sunday. So the classes are on Sunday morning, so you can go watch the Bears and the Lions game in the afternoon if you want to. So,
Do we have a commission meeting that day, the 10th?
Yeah.
We do.
I don't know.
No, not according to my calendar.
isn't it
I
right
don't-
after the
Back on
election?
3-week.
Oh, so the 17th, okay.
Mhm.
17th.
But the election is the 4th.
I believe that's correct.
Yeah.
Wasn't there this is not a pension meeting discussion. We'll talk about it later. Okay.
Sounds good.
Another trustee comments? Okay. I think I pulled that we can just adjourn if we didn't change the agenda, and we didn't, so meeting is adjourned. Thank
All
you.
right.
Thank you.
Not bad.
Pretty good. Through that. Now that I'm thinking about it, this is a new state law that like, John talked about.
There's an
the
extra
meeting might
SEI
be
report, and I'll
different.
trade
Right
this.
now, it's supposed to be
This whole
December
page is for
1st.
one of those.
December.
If there's not an extra, this is fine, but it's just a big pile of paper.
I marked up mine.
Well,
Ben, do you have ones that are bound? Can you give one to Bob that's just?
if you got an extra one,
That's right.
I'll trade you.
That's,